Today, I want to discuss management accounts and then tax. And it's probably ideal because SARS is sending out SMSs, tax season has started now. And for your company, RP6s are what's coming up end of August. So your company's not doing personal tax, your taxes now. Your company's taxes are only going to be due January next year. All right, but it's a good time to start planning. Halfway through the year, you got a good idea roughly if you're going to make a profit or not. Obviously, profit, you pay tax. If you don't make a profit, pay any tax. All right, so we want to just run through this now, which is a good. We're not going to go about me. So while we're here, yeah, management accounts. A lot of people always wonder what is management accounts, and it's exactly what it's for: profit and loss, and your balance sheet. Now, a lot of accountants will get you all like, profit and loss, and try to explain very, very complicated what these things are. But it's, as the name is saying, profit and loss. So what a profit and loss will do, it'll be a case of whoever you invoice, so all your sales, less your costs that you're paying for those. I mean, if you're doing services like this, there's obviously very little cost, and then your expenses. So if you own a fruit and veg sort of shop, you'll have sales. The costs will be your vegetables, your fruit and veg, and then your expenses will be underneath that. So it'll show you if you're making a profit on that month or on that year. And that's quite an important indicator, obviously, as a business, to see if you're actually going to grow or not. And I want to dig into it a bit deeper. I've got some slides on an income statement and a balance sheet. But the balance sheet is, as the name also says, it's the balances of things that are owed to you or that you owe other people. So, for example, you do sales, your customer hasn't paid you, you're an asset, they owe you the money. So your debtor owes you the money. So that sits on your balance sheet. You've got invoices from your suppliers, you haven't paid them, that sits on your balance sheet as a creditor. Your bank balance sits there, the outstanding amounts for motor vehicle installments. So that sits on your balance sheet. It shows what is the actual balances that you owe or someone owes you. And that really is as simple as what income statement and a balance sheet is. So, I mean, it can get a lot more complicated, but I think just for the understanding the concept of it, that makes this is the easiest way of doing it. There's no convoluted, like technical terms, technical words around it. That's the easiest way to do it. And some of you guys who've been at the other talks we've done, every single entrepreneur knows three things: who owes them money, who do they owe money, and how much is in the bank. Yeah? And that is your management accounts. Because who owes you money or who do you owe money is in your balance sheet. If there's money in the bank, it means that you're doing sales, income's coming in, your income statement. Okay. So I want to just go through those. We'll dig into a lot deeper because I want to look at the costings around it as well, so we get a clearer understanding how we make money. Because too often, us as small entrepreneurs don't get our actual invoicing right. So we do lots and lots of turnover, but we never make any money. We always go, why is there no money in the bank? And I want us to just understand that a little bit more. Okay. All right. So the purpose of management accounts: help you plan your business. What's your thinking? Like, do you hire more staff? Do you buy more stock? Things like that. So if you're a seasonal company, a nice example, of course, like a lot of your sales happen towards the end of the year, in December, holidays, stuff like that, you'll probably find that your product is cheapest now. So if you had money saved, you could probably buy your product now When it's winter, when no one wants to buy summer stuff, and you'll get a lot cheaper. Then when you sell it in December, when everyone wants the summer stuff, you'll make a higher margin. But that comes from your planning. By looking at your sales cycle, this is where the management accounts actually feature. So it helps you with your decision planning. If I hire a staff member, that's not just their salary or their wage. Maybe that staff member needs a computer. Maybe that staff member needs a desk. Maybe your office is going to be too small, so now you need a bigger office. That's part of your planning. That's where you need to start using your management accounts. And too often, if we don't do our books on a monthly basis, you don't get a chance to see this in real time. You might see it at the end of the year. You might not even look at it at all. You probably might not have even seen a set of management accounts. Your accountant did it to get a tender, or the bank wanted it to approve a loan, but you don't know what the detail is inside there, why it's there. So this is what we want to do, is make sure we understand it. So sales cycles, very, very and important. A lot of companies in South Africa, especially because we close at the end of the year, most actual companies in South Africa have a sales cycle from Easter to the end of November. That's when you make the most of your money. Because December's holidays, so unless you're in retail, unless you're in entertainment, those type of things where people want to spend their holidays, you make your money in the holidays. But for the most of the companies in South Africa, you're making your money from Easter till the end of November. So you're going to look at that sale and see what that sales cycle does and do your planning accordingly. Like we know as accountants, we very rarely would sign a client from January to Easter. So we might have a little bump in Feb when SARS is making noise about its financial year end, get your logbook, the advertising on TV now, SARS is making a noise. We might get 1 or 2 clients because they're a little bit nervous, though, SARS money, but it's quiet. The bulk of our clients will come from Easter till now. And this period now, when SARS is chasing, personal taxes due, people getting SMSs, you owe money, that's when we've signed most of our clients. So we understand the cycle, and it's good for you to understand that, where you're going. And it can be something as simple as, I use the example often of the lady at the taxi rank just doing Fed Cook. Her sales cycle is 5 in the morning to 8 o'clock in the morning. That's it. But it's every day, but not on Saturday and Sunday. Unless maybe there's a game on Saturday, then she's busy on Saturday. But her sales cycle is 5 to 8, 5 to 8, 5 to 8, all year round. You see? So just see where it fits inside your company, and you're going to get that from your management accounts. Okay, matching your cost to your income. This is a big headache for a lot of SMEs. We were actually with a client up in Richards Bay Monday, and he had a big sort of sale item, like R500,000. And now his management accounts for that month look good because he's made a massive profit of like 300,000 Rand. But the very next month, his sales are only 100,000, but he's got a cost of sale of like 400,000. So he had to pay for the product. So the customer paid him early. He paid for the product in the next month. So if he had just looked at 1 month, you would think, I'm loaded, I've got some cash to spend. But now when you look at it over 2 months, it's like, not so much, not so much money, because now you've had to pay for all that stuff. And it's helpful for you to then plan how you're doing your buying, plan things like that. So using the example I said earlier, if your main sales are over like the holiday period, try to buy as far away from that as you can, because you'll probably get it cheaper. So if you're buying ice creams in winter, you're going to get them cheaper than if you're trying to buy ice creams in December when everyone wants ice creams. So I can buy them cheaper now, I'll sell them more then. So that's with that, getting the costing and your income, planning it accordingly. And then cash flow. Cash flow is the thing that kills us. 99% of SMEs, guys our size, smaller businesses, We never need a business loan. When we need a loan, it's a cash flow loan. You generally don't want a loan to fund your business and get a bar. You want something just to fund a deal. You want money to fund that deal. I've got a customer who's going to give me 100,000. I need 80. I'll make 20 tomorrow, like this. But the bank says, no, but we don't fund cash flow. What about your equity and this and that? By the time you've missed that deal. So most of us SMEs want cash flow funding because our margins are quite good. So, and this, if you've got your management accounts right, you can plan your actual cash flow. And cash flow is also important in the sense of you got big clients, the corporates like to pay 60 days, 90 days. But because the people that we're buying from don't actually know us, we don't have a credit history, they want us to pay cash. So I'm going to put up the 100,000 Rand now, but my customers are going to pay me in 90 days. What do I do for three months? So that's the cash flow planning. How do you manage that? Because in between the 100,000 Rand sale to my client and me putting up the money, SARS wants their VAT in between that time. Where do I find the cash? So having your management accounts in order will let you plan for that. You see, so you tell your clients, no, you're going to pay me 30 days. The best business is clients pay you cash and you pay your people 90 days, like Shoprite does. Everyone pays Shoprite cash. Shoprite pays Pioneer Foods and Tiger Brands 90 days. So they've always got cash all the time. So these are the main things why you want to have your management accounts in order. Questions on this so far? Nothing. Okay. So this is what a profit and loss would look like. Hopefully it's clear enough. Just see if I must just. Yeah. It's about as good as it can get, but I want to show you what the importance is. And if you're doing yours, you don't need a fancy laptop or accounting system. You can take just a piece of paper and it doesn't matter. Got your sales, your cost of sales and your expenses and write them next to each other. And the key is to try to do exactly that. Write them next to each other. So this is from the start of this year. The financial year normally starts in March, but it can be whenever your financial year starts, whatever you want to measure. So the financial year in this case starts March. And every month there's March, April, May, June. And the reason you want to do that is exactly what I was saying earlier about planning your sales cycle. Now, if you look here, this person's done 430, then it's delivered, yeah, 300, then another 300, then 380, then 290. So you see, it's slowly doing this. So in this case, they've got a pretty stable sales cycle. You know, the example we use for the guy up in Richards Bay on Monday, 600,000 Rand Thursday, on March, 150,000 Rand April. Because generally over Easter, things often slow down. So it becomes very, very lumpy. So you can see here now, this is fairly, good start of the year, and then it went up and then slowly down, then down. And then your cost of sales are important to measure because it gives you your margin. So what does it cost you? And it's slightly different in terms of operating expense. And I know if you guys did this talk last year, you'll see the slides have changed purposely because I wanted to dig into this because this kills SMEs every time, getting the costing right of their product. Totally wipes you out. I promise you, if you don't get this right, you're not making any money. You're chasing turnover, you get turnover, you don't get any profit. Profit is the thing that keeps you alive. That's what keeps you alive. Okay, not turnover. Turnover doesn't keep you alive. All right, so what you want to do is the cost of sales should be the things in here that you make your money from. So if you're selling fruit and veg, flowers, whatever, you own a shop, The stuff on the shelf is what keeps you alive. You're putting a margin on that. You're marking up that stuff. Okay? If you didn't have any sales, what don't you need? And these are the things that can, like OPEX should only be the things here that you need to keep your doors open. So it'll be your phone, so people can reach you, you can reach your clients. Be yourself, probably, your income, your staff. Not casual staff, not anyone else that's linked to your sales. Because if you've got 100 salesmen and you're making no sales, do you need the 100 staff? No, you're going to cut that off. So those salesman staff will be in your cost of sales because they're linked to your sales. So the only things in OPEX here should be your bank charges, your phone, your fuel to get to work and back, not the fuel to drive the truck to drop off stuff at the client, because you're not getting sales, you're not driving your truck, you're not spending the fuel. So just the stuff to keep your doors open. That sits in operating expense. Because what happens now, if everything else is under cost of sales, the wages that you need to, if you have a shop, the staff that have to pack the shelf, the staff who have to run the till, they are all there because customers come in to buy the actual product. If no one comes in the front door, are you going to have those staff? Probably not. You'll probably be able to do it to 1 or 2 customers, you'll do it yourself. So just think about it in the bare minimum, because you're the last person you fire. You're the last person you fire. But go to the bank and you get a bank loan. They say, no, but you, a business owner, you're high risk, but your staff will go to the same bank with their pay slip that work for you, and they'll get a loan because their job is safe. But you, the business owner, who's going to keep that job until the end, is not safe. So that's what I'm saying. So if you keep just those costs underneath there, and everything goes to cost of sales, now when you work out your price, what your selling price is, you got all these expenses under, these are your real costs. Now you must put your markup onto that, because that's how you're going to work out your selling price. And that will then, that GP, your gross profit, must be enough to cover these bare costs and give you a profit. Now your profit should be as high as you can possibly make it, but minimally. I can tell you now, I can put R1 million in the bank at African Bank, and I'll earn probably 10.4, 10.5%. That's 100,000 Rand a year for this much effort, but nothing. Me just leaving my cash in the bank at African Bank. 100,000 for doing nothing. It's about 8,000 Rand a month. 8, around about there, a month. But then I want to spend my same R1 million. I want to do all of this noise, all of this. And when I look at my profit, I'm making nothing. Why? Why go through all the headache, all this noise, when you can take the same R1 million and make 100,000 Rand for doing nothing? Sitting at home, drinking a beer. No, that's exactly it. I'll be at that Tuesday every day, spending my money. Every day. So your profit should minimally be more than what you can make if you put the money in the bank. That's why it's important. That's why I wanted to spend time going through this. Because too often, we don't know the true cost of sales. So work that out, add it up, work it out. Think of your business, once you've stocked it, who do you really need? When the chips are down, what do you really need? And generally it's, as I say, it's, you need some way for you to reach your customers and for them to reach you. So phone, internet, you got a website, how do you reach it? You might drive, so you need your car, fuel, insurance, If it's a shop, rent, because it can't move anywhere. So you minimum yourself. You've got to pay yourself. If you definitely need two of you, then yourself and a staff member. Work out the minimum, and that's your operating expense. Everything else goes towards what you need to spend to make sales. And that'll be cost of sales. You'll have a much better, you'll definitely make money. Because now what sales does, sales has to cover the cost. That's why it's called cost of sales. So it has to cover the cost of your sales, and then your operating expenses, and give you profit. And that profit had better be more than what you can make at Africa Bank. Otherwise, it's a hobby. I promise you, it's a hobby if it's not. If you're not making a profit, it's a hobby. Okay. Questions on this? Any quick things you might want to just ask? What would fit in here? Anything you guys want to ask on that?
Using cash basis, if I issue an invoice, the client will pay me 80 days time. When do I account for that? Say.
So as an accountant, in South Africa, you have to use accrual. That's the standard, although there are exceptions. And funny enough, one of the exceptions are actually accountants. And lawyers, so professional services, especially if you're a sole prop, you work on a cash basis. So you'll exclude all your debtors. But for the most part, if you're running a spaza shop, it's cash basis. No one has an account. If you do have an account, it's the people and stuff. So generally, it'll always be on accrual. Yeah. So for the people who don't know what accrual and cash basis, so accrual basis, especially, and SARS loves it because that's how they charge you back. So what the example you used earlier, I invoice my client, and if I'm VAT registered, I owe SARS VAT on the money. But if I only get paid from my client in 90 days, I've still got to pay VAT in 60 days on that invoice, which I just invoiced my client, even though I haven't been paid. So the cash basis, and it changed, when was it about? I think about 2001, 2000, you could still choose either way. But then on a cash basis, you only pay VAT on the cash you got in. So you never had to worry about invoice somebody, I haven't been paid, I've still got to pay VAT on that invoice. But on the downside is when you received an invoice, you couldn't claim the VAT unless you had paid the invoice. Nowadays, you can claim, as soon as someone invoices you, you can claim your VAT, even if you haven't paid the invoice. So that slightly offsets if you're invoicing your clients and having to wait for VAT. Okay. So understanding then cost of sales, OPEX. Guys, any actual questions on that? Yeah, I'll give you guys one. So we use examples of shops and things like that where you have cost of sales. Accountants, like us, lawyers, if you salespeople, stuff, you don't really have cost of sales, but what you're selling is time. So effectively, I'm selling my time. I might be doing income statement, I might be doing a tax return, but it's my time. We've worked it out. You've got 1,600 hours a year if you sell time. And you might be a beauty therapist, you're a hairstylist. It's time. You're spending time there to do the hair. 1,600 hours a year. If you want to laugh, yes, you can work more. When I was young and single with no kids, I would work 2,500 hours a year. Because it didn't matter. I can go from the office to the nightclub, have a jaw, come back to the office in the morning. So if you want to laugh, 1,600 hours a year. Now you work that out. If I want to make R1 million a year, divide that by 1,600 hours. That's where you're going to try to work out an hourly fee. What you can charge clients. So that'll vary based on your scale. When I started out, I think I was charging like 250 Rand an hour. Now it ranges from 1,800 to 3,500 Rand an hour, depending on the clients I'm seeing. And that comes from skill, obviously. Like if you've got a lot of clients and you've only got 1,600 hours and you've got more clients than what you've got time, what do? Push the price up. Some of the clients will fall off because they can't afford it. You still got more clients. Push the price up. Push the price up. I've never met a poor hairdresser in my life. Ever. I've never met a poor hairdresser. They've always got money. They've always got clients. And if you're a good hairdresser, when you move, guess what? Your clients move with you. Okay? How many ladies change hairdressers every month? Never. Never. That hairdresser's got to die or she's got to move out of the province before you change your hairdresser. Eh? No. Us men, we don't care. We just like, finished. Hair's gone. We don't care. Eh? I know this because my mom used to own a hairdressing salon. So that's where I actually learned it from. So look at those things. If you get this right, and don't worry about accruals, fancy accrual systems or computer accounting programs, take a piece of paper and literally go back to March of this year and do this exercise. How much sales? And if you're not sure how much sales you did, look at your bank account and see or remember roughly what cash came in, what your costs were, and do this exercise. I can tell you now, all of you are going to realize very quickly you must increase your price. That profit line at the bottom there must be more than if you took all the money you've started your business with and put it in an African bank. Minimum, it must be that. Preferably more, 15% or higher, preferably. 25 is great, but nothing less than 10% profit. Otherwise, you're never going to make it, because if you can't accumulate your profit over time, when you have a bad month, where does the money come from? And the profit is after you've been paid. Include yourself in your costs. Don't leave yourself out. Because too often us entrepreneurs, I will get our payout, after the profits, we'll take our money. If you don't include yourself in the cost, you're not going to include yourself in the price at the top, in the sales price. And if you never include it in your sales price, your client is going to get you for free. And slavery is illegal. So why you want to be, having to work for free?
If you look at the cost of sales and the gross profit margins, the first question will therefore be, what is the acceptable or the normal acceptable, percentage for the GP for an SME to ensure that you are right above water when it comes to.
So, what's an acceptable GP is the actual question. You got to work it backwards, and it will change by industry. So once you've got your basic costs that you need to have inside your business, whether just to keep your doors open, whether you make one sale or not. So once you've got your basic costs, that'll give you your OPEX. So let's use an example. So my OPEX is 10,000. So now what happens is, whatever my cost of sales are, my sales have to be more than that to at least give me 10,000 Rand to cover my OPEX. So let's go and say, let's go to 100% markup. So now my cost of sales, use the fruit and veg example, I buy 10,000 Rands worth of fruit and veg, I sell them for 20, 100% markup. Now my OPEX is 10,000 Rand to cover my wages, my shop, and those type of things. So now my OPEX is 10, I'll break even. I haven't made a profit. So if I want to put that money in an African bank, at least minimum, I need 10% of that. So I have to now sell for 21,000 So our margin is going to be more than 100%, 110, 115. So whatever your margin is, that'll then cover your OPEX and leave you with a profit. So if that was the case, the fruit and veg, what you'd rather want to do is 150% markup. Because now if you spend 10,000 Rand on fruit and veg, 150% you're selling now for 25. You pay your costs for 15, you pay your OPEX, you live with 5. That's a much healthier margin. And play with that, because two things happen here. One, if it's high value items, the margin's higher. If it's a low value item, like fruit and veg, you're going to sell lots of it. So what you're going to find is that I'm going to sell lots of fruit and veg at only maybe 50% markup. And because I'm turning that fruit and veg over fast and faster, like Shoprite does, they turn that food over. So before Shoprite pays that first invoice on the stock, they've moved that thing already 17 times. They've sold it 17 times before they paid their invoice. You see? So items where you can't put up your actual markup high, you've got to sell often, sell fast. Items where you, like sports cars, where you only have to sell one a month, the margins are nice and high, and you don't need lots of people. You can sell a sports car on your own. But to run a shop, you need a whole bunch of people, and that changes your OPEX and stuff like that. So there's no sort of like an definitive. Yeah. But generally, you want to work it backwards. Work out what your profit is, what you need to, so that if your OPEX is, as I said, 10, you need to at least make 10 GP to cover your OPEX. But that's not enough, because you want to have a profit. So if you want a profit to be 2,000 Rand on a 10 OPEX, you just work it backwards, and what's that going to tell you? If I can sell it quickly, fine, I'll make it quickly. If I've got to sell it often, then that's how you plan your market.
I think that one is like this of selling things. If you are charging a markup on the item that you are selling, because sometimes you also need to add a markup.
Yeah, so that's your
There are
margin.
instances where you also do some labor work. Yeah.
Yeah, so that's exactly what it is. So that gross profit, and that's why if there's labor work, like your staff who are doing the labor work should be under the cost of sales. That you might charge them out at 200 Rand an hour, but they're not earning 200 Rand an hour because they're getting a monthly salary or a weekly wage. So they might be, if you work out the hours, you making 25,000 a month from their wage, they're only earning 10 a month because you made a margin on their wage. Then the product they're installing, we use your fire extinguishers and stuff like that, you've bought it wholesale and now you're selling it to clients with a markup, and that's also your margin. So those things can vary. If you've got multiple things, then you can change it. Like if I do a website, selling time to build a website, but then I can also sell my clients a laptop, so the margin's a little bit lower on the laptop. I might sell them a mouse or internet. All those different things I work on will have a different margin. But ultimately, your gross profit, the gross profit that you make, which is sales less cost of sales, must be more than your OPEX. And that profit must be more than if you put the money in the bank. Because who wants to work? If I can make 100,000 Rand a year by putting R1 million in the bank, why would I work? Why would I go through all that heartache? Finding customers, getting gray hair, for what reason? You want to do that headache for proper money. Proper money. Money.
I think what mentions over and above having management accounts in place studying them properly on monthly basis, which will help you as well in terms of just understanding on the OPEX side, on all your line items. As an entrepreneur, always try, as you review your management account, OPEX side, always ask yourself that all the time I need to decrease my OPEX by 10% every line item. Just study them and see where can I decrease it by 10%. That will help as much improvement that might affect on GP budget and profit, which will improve.
Before I go on to balance sheet, that's a very good point. And, you know, what's key about tracking as much information as you can is that, let's use this, so you're buying fire extinguishers and you got a person you're buying it from, and you know now, because you're working out, you're keeping track of your cost of sales. You spent R1 million in the last year on fire extinguishers. Yes, you've marked it up, you sold it to your clients, you haven't made a loss, but you spent R1 million. But you might not have known at the beginning of the year you were going to spend R1 million. Guess what happens now? Now you go to the same person you're buying from and you say, last year I spent R1 million here. My business is growing. If I spend that R1 million again this year, what price am I going to get? But then find somebody else and go to them and say, last year I spent R1 million with that car. What would you give me if I spent R1 million here? We did that at a restaurant for a client, very big restaurant. He does 100 million rand a year. So his booze bill every month is like nine bar every month. There's like lots of money. And we went to the liquor guys and said, this client spends between 7 and 9 million rand every month on booze. Very expensive whiskeys and beers, but, and the guy said, 10% off. Because we'll take it off, 10%. Okay? That's 700,000 rand that went from cost of sales to profit. Well, how much extra work? Nothing. Nothing. You got almost R1 million for nothing. So if you track these things, and now when you go to the guy you buy the fire extinguisher from and said, last year I spent R1 million. If I spend that R1 million here, and he says even just 5%, that's 50,000 rand. For no extra work. And it's from knowing your management accounts, knowing your costs, and just keeping a track of it. And it doesn't have to be flashy, as I said, just even if you're just writing it down and you know, because they'll know, because they have an account there for you. So they'll know. Okay, so that's key. So Mlondi, well done. That's exactly what you're after. Now move on to your balance sheet. This, if you think the income statement, so the income statement is there for your actual sanity, the profit and loss, whether you're making money or not. The balance sheet is for the bank's peace of mind. Okay, this is for the bank's peace of mind, because they want to see if your assets sort of are more than your actual liabilities. And what that is, obviously, assets are the things you own. So there's obviously your bank account, things like your customers. If you've got customers who pay you on account or they're paying you late, the money they owe you is an asset, it's yours. Okay, so you keep track of how much your customers owe you, and then your fixed assets. These will be things like your stock, your inventory, your computers, your car, your trucks, all the things that the business owns. Okay, and that'll give you a total of your assets. The liability side is who you owe money. Remember we said, every entrepreneur, who owes me money? Who do I owe money? How much is in the bank? This is where it hits home. So now, who do you owe money? So there's money there. So right now, if you want to do a quick cash flow analysis, very quickly, people owe me 9, I owe 8. Okay, I'm still good. I'm still good. I'll be able to pay the people who I owe money to. But now, things like unpaid expenses, your pay as you earn, your UIF, all the money you owe, if you had loans on your trucks, loans from the bank, anything like that, that's a liability. And what any funder wants to look at is, do your total liabilities, are they less than your total assets? So that means, and the bigger that gap in favor of assets, the stronger your company is. There is an unfortunate thing for us as entrepreneurs when we start out. We tend to fund our business ourselves because you can't get a loan. So we fund it ourselves, we fund away. And now what happens is inside your current liabilities is the member's loan account, the money the business owes you. You are the bank. The business owes you the money because you funded it. Now when you go for funding, they go, oh, but you're insolvent. The business owes more money than it owns. But it owes you the money. You see, so the banks do sometimes overlook that, but very often they don't. And they go, how do we fix that? And there are smart accounting ways. You do rights issues and move your loan up to equity, things like that. But that's what you want to avoid. You want to always make sure your assets are more than what your liabilities are. So in the Companies Act, it's illegal to trade in an insolvent circumstance. So if you're insolvent, you're not allowed to be trading because you knowingly realize your business can't pay its bills. So technically, it's fraud. You're actually telling somebody, I'll be able to do this job, but really you can't because you owe far too much money. So that's like an insolvency. Technical insolvency is if the business owes you the money. So technically, you're not going to go and close down your own company. So that's a technical insolvency, which often gets overlooked, but a genuine insolvency where your business owes more people money than what you're going to make, than your assets are worth. That's when you hear of companies going into liquidation and stuff like that. You see on the news and stuff like that. That's when that happens. So you want to watch that all the time. Keep your eye on those things. And what we find with a lot of entrepreneurs, because you've funded your own business, and I'll use the example on Monday again from our clients up in Richards Bay. We're having this chat with him about his balance sheet. And I said, I'm telling you now, I won't be wrong, but I guarantee you right now, the van you just drove in on, the tools you have, all the stuff that you've acquired over time, the desk, the computer that you're using, that you came to the actual meeting with, that's not on here. Where's your assets? Where is it? He says, yeah, but I bought those things. So I didn't know to put it into the company. The accountant didn't tell him to put it into the company. So all the assets that you paid for, that you've acquired over time, you went to the scrapyard, you picked up tools, hammers, levels, whatever you use inside your company, all those assets. Get a list of them. Roughly remember, it doesn't have to be 100% perfect. I paid R1,000 for this, or it's $50 for that. Or I don't even know, I found this. I don't even know how much it'll be worth, but go find out and go, if I go to a second-hand store, I can buy one for $50. So put $50 next to it. Keep that information, because that will come in an asset here. And if you bring it into the business, the company now owes you that money. And it will pay you later on as it starts to make a profit. Now your assets are looking healthier. This client suddenly worked out he had almost 700,000, excluding the vehicle. From having nothing, having no assets, to suddenly like 700,000 rand. And he didn't even realize it. So look around the stuff you use. Keep a list of it, bring it into your books. If you VAT registered, you can claim VAT on the second-hand goods. It's called deemed VAT. So very often you think, but now I'm actually registered. All those old assets, even if you've never claimed VAT on them, the day you get registered for VAT, you can claim the deemed VAT on those assets, which is a nice little start to get you going. You get some money out of SARS. Okay. So the balance sheet, this is what keeps the banks and awake at night. Keep the assets higher than the actual liabilities. So often if you don't get a loan, that's what it is. It'll be that. If they ever come back to you and say, yeah, it's a technical insolvency, you've got a big loan account, then all you do is your equity here, you just issue more shares. So you effectively buy more shares from the company, and that moves your liability into equity. It goes away. Okay. Questions on the balance sheet? So what happens is if it's in your personal name, but it's exclusively used for the actual company, you can bring it in as a company asset. The actual liability, you can bring the liability onto the books because obviously you'll own if there's a loan against it, you can bring the actual liability and you pay the loan out of the company. But that asset then you can bring it in as an asset of the company because it's being used full time. No, you just sell it. Used a one-page sale and agreement. Done. Claim the deemed VAT if you've VAT registered. Yeah, very, very easy to do. And there's lots of that. And people don't actually know because accountants are lazy. They don't actually tell the clients that. You know, a lot of accountants just assume you know what they know. But I can tell you now, if you start asking them the things we've just spoken about now, you're going to realize that you probably know more than they do right now. A lot of them. Promise you, a lot of them. And you're going to discover it more when we get into the tax side of this. So just to wrap up the management account thing, income statement keeps your mind clear, keeps you focused on your income and your costs, and to make sure your profit is more than if you put that money into a fixed deposit at African Bank. 10%, I promise you, if you're not making that, put the money in the bank. The balance sheet keeps the bank sane, so make sure your assets are higher than what you owe people, your actual liabilities. Look for assets, guys. You are all using stuff that you bought or your mother gave it to you or your dad or your brother said, yeah, use it. I don't need it. All those things are assets. Please bring them into your books. That's going to make you a lot more valuable. Okay. Very, very crucial. Cool. I'm going to get into, let me just show you this slide. This is what we as accountants or advisors, accountants won't generally do this. But as an advisor, this is what you want income statements and balance sheets for. All these sort of ratios calculate how your company is doing. And it gives you an indication of the health of your company. So we would often take your income statement, your management accounts, and we do this. There's your cash flow, what it's doing. So you know, you don't go start trying to find money. Yeah, it's far too late. You go hit the bank there and they look at your account. It's looking healthy, but you know that's on its way. So you go and you get the loan there. And then what happens is you can afford to pay it here because your sales have dived. So then you know you've got the cash. Because when you go to the bank there, they're like, I can't help you now. There's nothing. And that's the importance of having your management accounts. And this is like trend line. So when you map all your sales numbers and your cost of sales, that's what this does. It creates like a trend. You see, like, it shows you what your business is doing. It's got a nice flow to it. So your highest sales will be here and your higher sales will be there. So if you can, you want to be buying your stock here. So like I always use like Christmas as a perfect example. Christmas decorations are expensive December, end of November, early in December. Those things are expensive. But if I'm a decoration salesman, when's the best time to buy decorations? June, now, July. Because who wants them? So I'm going to China now when no one wants them, and I'm buying it now where it's cheap. And I'm selling it to you over there. So I'm buying my Christmas decorations here, and I'm selling it over there. That drives up the margin. So as you understand your cash flow per header, you take the profits from here, and then you order your stock, you pay for it there, and you sell it again there. So if you understand your sales cycle, and that's how you work on it. Okay, maybe this is too long for you and you realize, yeah, I'm never going to make it. So what can I do here? So if I'm doing Christmas decorations, what's happening? Let me do winter stuff or something I can do. Let me sell hats and things here in my shop to have a separate income. I've already got a shop. People already are coming in, and then you can find another product to sell here, which will drive up your sales. So just, that's why you want to see it. You want to start seeing things like that. So that's what we take those numbers, and the numbers look boring. These numbers on a page, and no one really, it looks nicer when it's like this. Okay, so that's what you want to do with it. Cool. We'll do, yeah, taxes, and that's, yeah, definitely only two certainties in life, eh? Death and taxes. The thing is, you can avoid tax. You can't avoid death. Yeah, we've been through these. I'm not going to dig too much in these type of things. Yeah, we have these on our other talks, but just remember, I'll just go through basically, just remember at a certain time when you need these expenses, because not everyone needs to be registered for everything. So you don't have to be registered for that if your turnover is under R1 million. You don't have to be registered for pay-as-you-earn at SARS if no one in your organization, including you, earn less than 7.9 or something like that. So just there are actual thresholds. You might only then have to be registered for income tax, workman's comp, and UIF. So don't just register for all these things, because what happens is, and SARS has got clever, they'll always find ways to make money. You register for these things because someone says you need it when you don't, and you don't submit the VAT form now because you don't have the money, but you shouldn't actually have been registered anyway. Penalties, 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 penalties. And when you do eventually go and sort it out with SARS and you don't have to be registered, they don't write off the penalties. You're still going to pay the penalty. So just make sure with these registrations, do you need it? Does your business need it? Don't necessarily register just because a corporate or someone says register. We have seen a lot of it where entrepreneurs would kind of get onto a vendor list. You want to get onto a vendor list at a corporation, and they say, what's your VAT number? But if you're turning up at less than R1 million, you don't need a VAT number. So push back and say, I don't need one. The job I'm doing for you is not over R1 million. I don't need one. So when the time comes, I'll do it. Push back, because the lady or the guy in the office has got a box to tick, and he wants to tick the VAT box because it says get a VAT number. They don't question whether you need it or not. So just be certain which ones you need, and this is the order. So you register for income tax whether you like it or not. The minute you register your company, as you know, that information goes to SARS, and your income tax number comes the same day. In fact, you probably get your income tax number before you even get your company documents. So that's, you have to have. If your business is not trading or you're not making a profit, get someone to do a null return. Don't leave it because I'm not trading, or I'm not actually making a profit. I'm not going to do it. You'll get a penalty from SARS and you'll pay the penalty. So even if you do a null return, find somebody, we do it cheaply, $100, $150, null return. If you don't do it, penalties with interest, and it will accumulate. So just be careful with that. As I said, the other two important, minute you employ anyone for 24 hours a month or more, staff, 24 hours a month or more, you have to register for UIF and workman's compensation. Remember that. 24 hours. They work for you. 24 hours or more a month. Okay. And these are generally, for most startup SMEs, that's all you need, those top three. The rest comes later. They come on thresholds. So if someone's earning more than 7.9, yes, you're going to need pay-as-you-earn. If your payroll is more than 500,000 Rand a year, yes, you'll need SDL. That is R1 million. So look at these things. When you do your income statement now, when you guys go check it out and work out your income statements, have a look at this. If there's something you don't need to be registered for, deregister now. Please, you're going to save yourself a headache. Okay. Pardon?
Right, that's,
Uh-huh.
and I get grants funding. So I'm not really making money from like a business or an individual. It's the state giving me money to create the connectivity. Yes, I'm paying my with where does that fall in the revenue generated by say that is to make all that?
Okay, so the question's about grant funding. What is it? So grant funding generally will fall under other income, and it's non-taxable. So like if you literally just won the lotto, it's non-taxable. That means the assets you buy, you can't and depreciate those assets. Those assets can't be, although you use them inside the company, you can't actually and depreciate them to offset any other income you're making. It has to be ring fenced. So grant money, whatever the grant buys assets wise, gets ring fenced, but the grant will be used to pay salaries and wages and stuff like that. You still have to register for actual pay as you earn. If the people reach the threshold, if your staff reach the actual threshold, if they don't, then it's just UIF and workman's comp. Because you're not, depending on how you registered, if you registered as an NPC or like a PBO, I would recommend VAT as one of those counterintuitive ones. I'd recommend you register for VAT because you can claim the VAT on your expenses, even though you're not selling it. And that gives you a nice sort of also like an income flow to improve your cash flow. So you pay them like independent contractors and stuff like that. Something similar like it. So what happens is, just be careful if that 80% or more of their income comes from a single source, you got to withhold pay as you earn, even if it's an independent contractor. So they make 80% of the money from you, they're deemed to be staff, and you must withhold the pay as you earn. Yeah, just have a look at that. We do have a blog about it. Just if you pop onto our website, we do have a blog about it. So anything like that, if you instruct them to do the job and how to do the job, they're then deemed as employees. They're not really independent. Independent contractors would generally have more than one client, and they're independent. You can literally, like when you hire a builder to build your wall, you don't stand there and go, mix the dugger properly. You're not putting it on all those, going to take the shovel and shovel it. So that's independent. They can do the job. So if you've got to supervise them still, SARS has a list of things to check, and if they deem them to be employees, you have to withhold pay as you earn. But the first thing is 80% of the income. If they make 80% of the income, that's the first actual threshold. Beg your pardon? Not of the company that you're a director for. So if you own the company, so you're a shareholder. So there was a change. I'm just thinking how long ago. I'm going to say recent, but with COVID, a lot of the years have blended. So it could even been as much as 7 years ago. But and directors who sit on boards, because there are people that's their job, they just sit on boards. They are like and directors of companies. If they get a fee for sitting on the board, you must withhold pay as you earn. So because it's deemed as a job, because that's a job. A director is a job. So if you're one of our earlier talks, as an entrepreneur, you have 3 hats. I'm the shareholder, where I own the equity. I'm the director, where I make the decisions about the company, which is a staff job. And I'm the employee inside there doing what the boss just told me to do, which I was myself. So those 2 roles, if you're earning income, you have to be paying pay as you earn. Okay.
With regards to the boards, How do you then classify them when it comes to the management accounts? Do they fall under salaries?
Yeah, so what you'll normally do is where there's and directors, let's go back to that slide. So generally, like you'd have like and directors remuneration. It's a separate line item that they would normally have on your operating expense for the board of and directors. So generally, if you're the owner of the company, your income is separate from the staff that work at the company. It's just part of IFRS. They've started separating them out for a while now. And that's where you always see these stats that and directors earn 1,000% more than what the lowest paid staff member earns. And it comes from that because Stats SA has now been able to track it on the things along those lines.
Just
We have a question in the chat.
So hold on, Ed, I'll get to your question now. So payment for and director, would it be just salary and wages, or is it a and director's remuneration? So very often in the smaller companies, they just view the and director, you're a shareholder and you're on the board. Everything you earn goes to the and director's salary. But it would actually probably be a good, that's just admin for the smaller guys to make an issue out of it. But generally, I would advise splitting it. We've got clients who own mines and stuff like that, and they've got other people who sit on their board, and we split them out. So if you have a board meeting, it's 5,000 Rand a board meeting, and that's shown as a separate line item. And then they part of the sort of executive salaries and wages. Instead of salaries and wages, it'd be executive salaries and wages, and then board fees as a separate line item.
instead of to pay myself in the company, the line item.
It's entirely up to you. In a small firm, it's entirely up to you. Yeah, just depends on how much headache it is. But and also what the purpose is, because if you want to recruit other board members later as you're growing, you can show them what you earned for sitting on the board, for doing advisory work on the board, so they can get an idea. When you say, look, I've been able to pay myself X, and if you join my board, I'll pay you X as well for every meeting, which is separate from my earnings. They don't go look at it and go, yeah, all those project management fees, I also want those. No, not happening. You sit on the board. Unless you get too many guys and then they vote to make the project fees part of the board fees, then you got a problem. So there's a question online. Ed, the question? Oh, no, there's a question online. I'll take that one now. Ed?
Now, in regards to directors' loans, is there a chance that SARS would audit it? And is there a specific percentage of the company's revenue that the director loans shouldn't exceed?
Okay, that's a very good question, Ed. So around and directors' loans. Remember, I'll go back to the balance sheet that we looked at a bit earlier. So it'll be, if you, as we spoke earlier, you funded the company. You did all the funding of the company. It's a liability. The company owes you the money. You can charge the company interest. So very often there's 21,000, 22,000 as a threshold for interest where you don't pay tax. And very often we find with very small companies like ours, all your money is invested inside your company. So you're not going to have investments where you're earning interest elsewhere. So charge the 21,000 Rand interest on your loan account so the company will pay you. If it's the other side, the company is doing well, but you've been taking the money. So you haven't been taking a salary, you've just been taking the money out, so you don't have to pay any pay as you earn. SARS deems that as a dividend. So they will want you to pay dividends tax on that. However, if you charge interest on that loan, if a company charges you, the director, interest, And the interest can be prime, whatever prime interest rate is. Right now, it's a little bit higher than it was a few years ago. I think it's about 9 point something now. But if you charge prime, it becomes interest income of the company. SARS will leave you alone. Okay, but if you just take the money and you don't charge interest, it's a dividend, and then you pay the dividends tax. All right. So just Ed, does that help?
Yes, thank you.
All right. Cool. Your question.
Sure. I just wanted to check. Yeah, I'm running a organization. I think my brother also made it to be similar questions kind of, but I'm also contracted to the organization in terms of service providing. So as a director or a board member in the organization, but also my company is also doing some services. So with the organization, is it still the same policies or structure in terms of how to operate in the space?
Okay, so what we're going to look at, so it's around multiple organizations, and whether you're born in one organization or you're earning income in another organization as a salary, as a shareholder and stuff. What you're going to remember, first thing to remember about tax, and if you're going to pay tax, each of the companies, you can own 10 actual companies, or you can sit on 15 boards. It doesn't make a difference. Each of those entities are a separate, they pay taxes separately from you. You're a taxpayer separately. Now, you as an individual gets taxed on your worldwide income. In fact, even a company in South Africa gets taxed on its worldwide income. So if that entity pays you something, if it doesn't withhold pay as you earn, it'll come into your personal taxes and you pay tax on it. If they withhold pay as you earn for sitting on a board or for doing a project, whatever, they'll take away pay as you earn, you'll get an RP5. So when you do your personal taxes and SARS picks up, you got this extra money, here's your RP5 to prove you pay tax on it. You see, so just remember, you can earn multiple incomes and they can be complicated. One can be because you're doing introductions. One can be because you're actually physically working in the job. You're getting project fees and stuff like that. Another one because you're very skilled at what you do. You're an advisor, so you're on a board and you're getting board fees. So those are all very separate things. But if it's an individual and you, in this case, what you're talking about, if you're sitting on a board here, they want a board member. They view it as a job, so they take pay as you earn straight away. If you're just advising and they see you as an independent contractor, you would be an independent because not more than 80% of your income comes from that advisory work because you're doing your other work, project work, or you're getting commission for doing this. So each one will just be viewed as it's happening, what the actual circumstances are. And then if you're unsure, Londy's here. He'll come and sit with you here and answer some questions and stuff like that. He's not that expensive, everyone. He saw the talk earlier, so he knows what the profit margin must be. Yeah, so just view the taxes in terms of who's paying it. The business, there's different taxes. You as the individual, there's that sliding scale for taxes. Right, starting at as sort of low as 18, going up to 42. Business starting as low as 7, going up to 27 now. So it's slightly different. Trusts a bit higher at 40, but just look at who's the organization that's paying, and their tax will be taxed accordingly. So I want to just dig into the tax now because it's coming into what we're talking about. So governments do offer incentives. We do see it. Unfortunately, ours is not moving as fast as other countries, but it is their small business tax. So incentives are there. Obviously, the idea is to reduce your tax. These are the type of incentives in SA. Reduce your income tax. So if you're a small business, the first 500,000 in profit, you pay roughly about 10% tax. There's a table I'll go through now with you guys. Accelerated and depreciation. So all those assets that you didn't put on your books, that you have, that you got somehow over years, you've been buying them while you had a job and stuff. Those assets, you get to write them down. Becomes an expense on your income statement. It's not a real expense because the money's not going somewhere. It just lowers your tax, lowers your profits, lowers your tax. Compliance burden. They say this is what some of the stuff does, but in South Africa, we get a new law every day. So our red tape gets higher. So I don't think our compliance burden in South Africa is coming off as a lot easier. But SARS does also write off taxes. Very often, if your business is in trouble, you've owed taxes for a number of years, you can do like what they call a condonation agreement, and you can have a meeting with SARS, work out a plan, and they might, if you can settle it, maybe you owe them 100,000 Rand as an example, you might be able to pay 20,000 and they just done, settle the debt, done. So those things are actually available. They don't advertise them a lot, but they definitely are actually available to, like, especially small and medium enterprises. Under the old apartheid days, what happened is SARS then would close your business, stick you in jail. Because it's against the law, you owe the state tax. You're stealing tax. It's, you know, they saw it as their actual money, not our money that we're paying them. SARS now is a lot better. They've realized it's better to keep your doors open. It's better to keep you paying, even if you're paying a little bit every month. It's going to take you 10 years to pay off their debt, but at least they'll get the money. You'll be trading, you'll be paying pay as you earn or whatever back. Somewhere along the line, it'll keep the things up, operating. So there are some things you can do. Okay, so we have, this is something I talk about a lot. The guys who've been to these talks, you know, small business corporations tax. And I talk about it a lot because I really want you guys to understand it. You know how many accountants don't even know about it? And I'm not joking. We get most of our clients, they come for a quote, they want to know, oh, can you help me? Can you help me? And I'll ask them for a set of their financials. And I'll ask the basic stuff. So in my conversation with the client, let me just speak. Because I know these things, because I've been doing it a while, I'll be having a nice little conversation. Oh, your business, how much are you making? Tell me a bit more about it. You start telling me about, my turnover is like 5 million. I'm going, tick, your business is less than 20 million. So I'm doing the maths already because I'm talking with you. What do you do? No, I'm a hairdresser. Okay, personal service, you won't qualify. Do you have people working for you? Yeah, no, I've got 3 or 4 people, they're braiding, we're threading, we're doing all sorts of stuff. Okay, hold on, there's 3 or more staff. Okay, cool. You might still be a small business corporation. You know, do you own any other companies besides this hairdressing salon? But it's got to be registered at CIPC. You might have a side gig, that doesn't count. A registered company. Do you own anything else? No, it's only a company I own. Okay, you're still in the game here. You're still a small business. So you're not you and have you got any partners in your company? If you say yes, I have. I've got a partner. Do they own anything else? Do they own another company? No, they don't. Both of us, this is the only company. Okay, you're still in the, because the minute somebody owns another company, you're out the game again. Okay, but for 90% of SMEs, you're the only one who owns it. So a lot of these questions sort of fit inside that. Professional services income. So professional services would be accounting, lawyer, consulting type stuff, where you needed a good qualification. Professional services, qualification to do. Architect. So in my business, is 20% or more coming from that? No. Okay, I'm still a small business. Okay, and you must be registered. So in my conversation with my new client that I'm talking to, he's giving me his financials. I'm having a chat with him. I've page over to the tax page. It's normally the last page of your annual financial statements. And I see the calculation, 28% tax. And I go, why did you do that? And he doesn't know, like, why did you cut? And then I go, our fees are X. So our fees for that company might be 3,000 Rand. That's 36,000 Rand a year. And I look at the tax that the previous accountant has worked out, and I go, if I gave you 96,000 Rand now, my fees are only 36, so are you going to sign up as a client? Of course they are. I've just paid my first 3 years fees. You can go back 5 years. If your previous accountant has got it wrong, you can go back 5 years at SARS, object to the last 5 years taxes that were done wrong because they didn't see you as a small business. And if your turnover if your profits were more than 500,000, you will get an average of 90,000 Rand a year. So that's nearly 500,000 Rand back in taxes. Yeah. And we see it a lot. There's a lot of accountants, and I'm using accountants in the broader sense of the word because a lot of the people actually just do bookkeeping. They don't understand the tax side of things. And that's just income tax. So just income tax alone. If your profits are higher than 500,000 Rand a year, that's 96,000 Rand. That's just income tax. The other side, all those assets we're talking about that you forgot to put on your books that you should have done. You write them off faster so you can depreciate it. So normally in an accounting term, if you own a van, you write it off over 5 years. Or if you own a truck, you write it off over 10 years. Cement mixer, 10 years possibly. So those things normally in accounting have a lifespan that you write off over between 5 and 15 years, depending on the type of asset. If you're a small business, computers, electronics, same year that you bought it. The very same year. I'll go spend 30,000 Rand on this laptop. I write 30,000 Rand off my profit. Same year. I buy a truck for R1 million this year because my truck's driving up and down, dropping off stuff. I write 500,000 Rand off my profit the same year that I buy it. 50%, 30%, 20%. You write it off over 3 years. So now I use the example. Now you've got a transport company. You bought R1 million truck. You've made 500,000 Rand profit. Now you write off 500,000 Rand of the value of the truck in depreciation. Now instead of paying 55,000 Rand income tax, what are you paying? Nothing. That 50,000 Rands, you can buy a whole thing of diesel. Next month's diesel paid for. This is where small business corporation tax really comes in. So now you've saved, if you were not a small, let's even take it one step further. You turned over 2 million Rand. You made R1 million profit. So ordinarily you'd pay 27, so let's say you'd pay about 140 and then 50, you're looking at about 190,000 Rand roughly of income tax on a bar profit. But because you're a small business, why you say only 190? Because the first 550 you only paid 50. 27% from the 550 up to the million. Now you write the truck off. You write off the 500,000. Now your profit's only 500,000. So your tax is only going to be about 50,000, 51. Look at the saving you've made on that. You've saved the other 140,000 in income tax just by writing off that truck. And if you're smart, you go and put it down and buy another truck. And what happens next year? You write off the 500,000 on the new truck, the 300,000 from the truck from last year. Now it's 800,000 off. Now there's no tax. Now you've saved probably 400,000 in tax, maybe 500,000 in tax. You buy another truck. Year 3. It does catch up eventually, because that's why I say you can avoid tax. You can't avoid death. So what you do with the tax is you avoid it. You're pushing it down the road. You're using all these incentives. But when the trucks are paid off and the incentives are being used and you're making your 2 million Rand profit in 5 years' time, SARS is waiting to get their money. But that's how you play the game. But maybe at that time you had to buy a big yard, and now you got to buy a building, and you built a building so you don't have any profits, So then you push it down, because now you don't have a profit, you don't pay tax. So that's That's how you play the game properly. Small business corporations tax done right. It's money. It's proper money. Proper money. And accountants don't show you this. Because generally an accountant, the only business they've ever owned is that accounting firm that they're busy running. And they're battling just like you to pay the bills. They're battling just like you to find customers. They're worrying if they're going to pay tax. Because they've never run anything else. They've never run a spaza shop. They've never run a transport company. They've never done that. Okay, so look at these things. Go look at your financials. If you've ever had to do and submit them, go home and check. Check your tax calculation. I'll be very, very shocked if Mloni doesn't get an email or a phone call on Monday or this week, even Friday, going, I've overpaid tax, can you help me? Because that's what's going to happen. So just to give you an idea, basically, yeah, so you got to be careful. So I'll give you an idea just on tax. So if you're not a small business, I mean, you can see the different steps, but if you're not a small business, if you made 550,000 Rand profit in your small business, that's not a lot of money. You know, if you work it out, you're looking at about 42,000 Rand a month. Okay? You would have paid SARS nearly 150,000 Rand. But because you're a small business, you're only going to pay them 57,000. You're saving 90,000. 90,000 will probably buy you a Datsun Go. Okay? You'll pay a staff member for nearly a year pay on the 90,000. This is where small business tax plays. And that's why I want to not get confused with also the other chat. Income statement, your management accounts. If you're looking at those amounts month by month like that, tracking where you're going to spend your money, are you making a margin? Are your margins improving? It leads into this. You can avoid tax. You can't evade it because that's illegal. You know, you can put your cash in the couch and pretend it's for selling bulls, but it's bull probably. You can't avoid it. You can. Okay, evasion's illegal. Look at this. If you've ever done financials, if anyone has ever submitted a tax return for you on your company, find the financials, have a look. Please. You probably find, I'm not going to say 100%, but you're probably going to find there's taxes at SARS, that's yours, has your name on it. Okay. So, as you know, we do and record these. So go onto our website. I'm just going to exit from here. Edit might just upset what you've seen, but I want to just exit the slideshow and I'm going to just hold it a second. I'm going to just put our website up so I can show you guys where it is. For some reason, it doesn't want to show it on the website. I have to do it old school. Yeah, there we go. Okay, so on our website, I'm going to try to track this backwards without looking, show my skills. On our website, under blogs, you'll see blogs in the wrong side. Yeah, I'll go back one. So on our website, if you go to SME.TAX, you'll see up here is our blogs and our articles. It's going to ask you to sign up for our stuff. Yeah, under blogs. All these videos, we record them and they come up. Okay, this is a podcast. So I'm trying to do this backwards, and as it's implying, I'm a bit backwards now. So these are the talks we've done the last few weeks. So come on onto our website. This will be up by Friday. Look at the small business tax thing we've just spoken about. Go through it, listen to it again. And purposely, we actually record these so you guys can go and listen to it. Take the notes from there. You don't even have to take notes. Just listen to it again if you want to. Check if you got annual financial statements. Check if you're a small business. If your accountant actually treated you as a small business. If you're unsure, come back and look at the things that actually calculate, are you a small business or not? And then you take it from there. I think a lot of you have got cash at SARS, especially if you haven't brought in assets. A lot of the things you might haven't brought in assets. So your profits are now inflated on your financials. Even if the accountant got the tax right, as a small business, because you never put the assets in, they didn't write them off. So even that tax, if it's right, will be higher than what it should be because there were no assets to write off. So just go look at those things that we've gone through now. And I can tell you now, you're going to surprise yourself. You can. Cool. Questions on this so far? No. Cool.
Question. Technically qualified. If this partner is a parent, but a shareholder, is still qualified.
Yeah, so the qualification is you've got to be a shareholder. So who's a shareholder? If your business partner is a shareholder and they own another company, besides being in partnership with you, you don't actually qualify. And there's always these little caveats. So we've had cases where clients own two companies, and then what they've gone and done is the husband owns one, the wife owns one. Now they're both small business corporations. Or if there's three, or you don't have a wife, you don't have a husband, you own one, your kids can own one. Kids can be a shareholder. Now it's a small business corporation. In the true sense, small business, because your kids are. Now, the directors are staff. The directors doesn't matter. You can be a director of 100 companies, you staff. They're only worried about the owners, who the owners of the company. And the reason why they've done that is because precisely what I'm saying to you, they didn't want people to go and say, I've got a 30 million rand a year company. I'm going to split it in two, and now I've got two 15 million rand companies. I qualify. If I'm still the same shareholder, I don't actually qualify. But if my wife's a shareholder of the one, I'm good. Or my kids are the shareholder, I'm good. There's always, as I get tax loopholes, but we want to make sure you're not breaking the law. And there are a lot of proper ways not to be doing that. So you want to avoid tax, you don't want to evade tax. Evasion's against the law. You go to jail, apparently. Cool. Ed, any more online? Questions online?
There's one more here. So it reads out as follows. In regards to income tax payable for the year end, is there a percentage you would recommend that should be aside from the total revenue received on a monthly basis?
No. So, guys, income tax is a penalty for making a profit. It's your actual punishment for being a good business owner. That's what income tax is. It's a punishment. So there's no amount. If you're consistent, if you've got a business that's in a growth phase, what often happens is all your proceeds of cash are going into stock and you're growing. So very often your actual profits are lumpy. But if you've got a stable business and like you own a guest house and it's full, So you know consistently you're gonna have 20,000 Rand profit a month, consistently. Then yes, you can put money aside, and it's normally you pay at the halfway mark, August. Your RP6, so SARS wants half their tax in August, and they want the rest of their tax in February. So that's when you would have to pay. So if you know you're going to pay tax, your accountant should advise you, because you're doing those income statements monthly now. All of you guys are doing it monthly now, after this. You'll know, come August, do I owe any money? And then you'll pay that over then, after the tax calculation. And then you'll do it again in February, because you'll know more or less if you're making a profit. So Ed, in terms of kind of keep a percentage, in a mature company, it makes sense, but work it towards your August and your February sort of RP6s. That's when it happens. Cool. Questions? Anything else before we wrap it up? Guys, thank you very much. There we go. If you run a company, so personal services is like, for us as an accountant, I'm doing my personal services, professional services, and now if I employ three other people, which we do, fortunately we've got 60, I'm a small business. But if I was on my own, you just pay normal tax, you don't qualify. So what will make more sense, if you are professional services and your turnover is less than R1 million, rather be a sole prop, a sole and proprietor, because now you can claim a lot more expenses, because a professional services company can only claim certain expenses. But if you're a sole prop, then you can claim a lot more. And then your income tax starts like as if you're a staff member, anything from 18% up to 42%. It often works out to be more cost effective if you're earning less than R1 million to be a sole proprietor. You can just close it down. Yeah, but have a look at it. If you're not sure, work those numbers out like we showed on the income statement and get an idea. And then send us them out. We're happy to have a quick chat, look at it. It's not going to cost you anything. And we can give you some proper advice, because too often, and this is what happens when registering a company, too often when we're starting out, we think we're going to register a company. And now if it doesn't work out the way it's going and you forget to submit your taxes, there's admin penalties, all sorts of other headaches. But if you have a job still and you start a side hustle and it doesn't work out, but you're keeping all your information, now you're at your employer 8 hours a day, then you're doing your side hustle. If it makes a loss, you can claim it on your income tax, you made a loss. And all the pay you earn your employer was taking off on your pay, you get a tax refund. Yeah, everyone's like, what the hell? Where did this come from? Yes. Do that rather. That's a lot smarter. And it gets you started into your business. Much easier. Section 12, income tax, much easier.
I don't know if take advantage of the concept. So, and there's an option to go in as a company, but I just don't know which space to play in, because if I'm invoicing at the company, SARS says where's my PAYE, then I'd have to take the money from the production company to my company and then myself and tax myself. Compared to just going straight into the production company as a freelancer and get taxed by 25% regardless. Because we don't have like an ongoing job. We work 2 months, gig is finished, 3 months, gig is finished. But the company, before it gets work, I'm pleading. I'm paying all the bank charges, so money coming in. But I need to renew stuff and I have to pay people for services like financial stuff. I have to pay out my own pocket. And when I'm going to the gig before I put my salary, I'm paying for my own pocket. So I am spending money on that company.
But is this your actual company?
Yes.
Yeah, so but then you must put those expenses in the company. You claim it through the company, your loan account grows. So when I'm going to look at do the side hustle, like you're working at a job. I got a job at, Mr. Price.
Yeah.
And now I want to start my own little label on the side. You're there. That's your job. They're taking pay as you earn off your salary. You can do it as a small business owner, but the benefits are more in the company. Because if the company has a loss, it runs the losses. If it pays you a salary, then the benefits are really in the company. There's smarter ways to do it in the company in terms of not taking a salary, using your loan account, paying 10% interest instead of paying 40% pay as you earn. So it improves your cash. Totally different vibe. So side is if you have a real and legitimate job for someone else, like the man, and now you want to start your own thing. Those expenses, setting up, there's a guy who did eggs. He was buying eggs, selling them. And he wasn't making money. He lost money, caused him some headaches, added up all the costs, put in his personal tax return, and he got back like 30,000 Rand from SARS. Now he could start himself again properly. Bought a better vehicle, more eggs now because it was volume. That's what he needed. And now suddenly, but it catches up because now eventually you're not making a loss. You only get tax back if you make a loss. So eventually he's making a profit, which means he's paying pay as you earn at his job and he's paying income tax on the profit he's making. So remember, it's not, you can't escape the tax man. You can avoid him. You can avoid him, and there's a lot of tricks to avoid him for a long time. But eventually you pay unto Caesar what's actually due to Caesar. Promise you. But while you're starting, it gets you off the ground. So if you can do that, there's smart ways of doing it, then by all means. Okay. Guys, thank you very much. I think this actual session was really good. I enjoyed. Hopefully it crystallized a lot inside your minds around why you want to look at your management accounts and why, when you understand your management accounts, what it does for income tax. So please listen to this next end of the week when it's online. Apply.